phase of addressing financial stress and non-performing assets. In the years following the global financial crisis of 2008, the Indian banking sector experienced a significant increase in stressed assets, particularly due to excessive lending to infrastructure and corporate sectors. To address this issue, a number of corrective measures were introduced. The Reserve Bank of India conducted an asset quality review to ensure transparent recognition of non-performing assets. The government undertook large-scale recapitalization of public sector banks to strengthen their balance sheets. Institutional mechanisms were developed for the resolution of stressed assets. A major reform in this context was the enactment of the Insolvency and Bankruptcy Code, which provided a time-bound process for resolving insolvency and improving recovery rates for creditors. This marked a significant step towards strengthening credit discipline and improving the overall health of the banking system. Recent banking sector reforms, 2014 onwards. Since 2014, banking reforms in India have focused on bringing more people into the banking system, fixing bad loans, merging banks to make them stronger, improving how banks are run, and using technology to make services faster and easier. Financial inclusion. A major breakthrough occurred with the launch of the Pradhan Mantri Jan Dhan Yojana in August 2014, which aimed to provide universal access to banking services. Millions of previously unbanked individuals were brought into the formal financial system through zero-balance accounts. Digital payments revolution and technological transformation, 2016 onwards. The period after 2016 witnessed an unprecedented expansion in digital financial infrastructure. The launch of the Unified Payments Interface in 2016 created a real-time, interoperable payment system. Rapid growth of mobile-based payments transformed transaction behavior, especially after the demonetization exercise in November 2016. Expansion of Aadhaar-enabled payment systems and digital identity infrastructure strengthened authentication and reduced transaction costs. This phase positioned India as a global leader in digital payments, while also improving transparency and formalization of the economy. Resolution of stressed assets and creation of institutional mechanisms, 2016 onwards. The persistence of non-performing assets, particularly after the credit boom of the previous decade, required systemic intervention. The enactment of the Insolvency and Bankruptcy Code in 2016 provided a time-bound framework for insolvency resolution. To complement this, the National Asset Reconstruction Company Limited was established in 2021 as a bad bank to aggregate and resolve stressed assets. The Reserve Bank of India introduced revised frameworks for stressed asset resolution in 2018 and subsequent years. These measures aimed to clean up bank balance sheets, improve credit discipline, and revive lending capacity. Consolidation of public sector banks, 2017 to 2020. Recognizing the problem of fragmented and weak public sector banks, the government initiated a series of mergers. The State Bank of India merged its associate banks in 2017, creating a larger and more efficient entity. In 2019 to 2020, a major consolidation exercise reduced the number of public sector banks significantly through mergers. Governance reforms and institutional strengthening, 2016 onwards. Improving governance in public sector banks became a key priority. The Bank Boards Bureau was established in 2016 to professionalize appointments and improve governance practices. The Prompt Corrective Action Framework was strengthened to monitor weak banks and impose restrictions where necessary. Efforts were made to introduce performance-based evaluation and accountability mechanisms. Although progress has been gradual, these reforms represent an attempt to address structural governance weaknesses. Recent legislative reform, Banking Laws, Amendment, Act, 2025. The Banking Laws, Amendment, Act, 2025 was enacted to update outdated provisions in banking laws, strengthen governance in public sector banks, and improve depositor convenience in a modern financial system. Key reforms include enhanced nomination facility, depositors can now appoint up to 4 nominees, simultaneously or successively, addressing earlier limitations that created legal and procedural difficulties in transferring funds after death. Improved audit framework. Public sector banks are given greater flexibility in determining auditor-related matters, aiming to attract higher quality auditors and improve scrutiny of financial statements. Cooperative bank reforms. Extension of director tenure and regulatory clarity aim to improve continuity, professionalism, and stability in cooperative banking institutions. Investor protection. Unclaimed deposits, shares, and financial assets can be transferred to a central fund, reducing idle funds and aligning banking practices with broader corporate governance standards. Updated thresholds. The Act increases the limit for defining substantial interest, that is, the level of financial stake a director or their relative can hold in a company, from 5 Indian rupees lakh to 2 Indian rupees crore. If this stake crosses a certain limit, it is treated as a conflict of interest, and the bank is restricted from lending to that company. The earlier limit of 5 Indian rupees lakh had become outdated over time due to inflation and economic growth, causing even small and routine investments by bank directors to be classified as substantial interest, which in turn created unnecessary restrictions on lending despite the absence of any real conflict of interest.